Hello and welcome back to my channel. In this video, we'll dive into wash trading, a market manipulation technique. First off, let's define wash trading. Wash trading is a deceptive practice where a trader takes on the role of both the buyer and seller for a specific asset, with the intention to feed the market false information. These types of manipulation can trick investors into believing the asset's trading volume is higher than it actually is, affecting the integrity of the digital asset pricing. Let's put this theory into practice. In the crypto space, multiple assets can fall prey to wash trading for different reasons. ICOs or initial coin offerings can be targeted. A company might resort to wash trading to artificially inflate the perceived value of the new coins, the new assets. This can manipulate potential investors into buying the assets at an elevated price. In the context of ICOs, wash trading creates an illusion of high demand for the token being offered, attracting more investors who think they're buying into a rapidly growing project. Now, wash trading can also be adopted as a tactic by manipulators to entice exchanges into futures listings, which offers coin developers or the asset's developer multiple advantages like higher liquidity and trade interest for the asset. When an exchange lists a new coin on the spot market, the developers of the coin may resort to wash trading. By doing so, they create an illusion of high liquidity, robust demand, and substantial market capitalization, all essential criterias for exchange to consider an asset's futures listing. In the NFT market, traders may buy into their own NFTs to stimulate high demand scenarios. Unsuspecting traders are then duped into paying premium prices for an asset supposedly in hot demand when in reality the demand is fabricated. This practice can also be used to influence the rankings of NFTs on various marketplaces, where they are often listed based on their trading activity. Traders may not only buy into their own NFTs to simulate a high demand scenario, but also engage in wash trading as part of a complex scheme for money laundering. By moving funds through various trades of NFTs or any other assets, the original source of the funds become harder to trace. Turning towards a real-life case study. The $4.4 billion EOS ICO reflects some manipulative practices. While EOS and ETH were not explicitly accused, the study did suggest possible wash trading through exchanges during EOS's ICO, potentially skewing prices. Researchers identified 21 accounts that recycled EOS tokens, totaling approximately $815 million worth of Ether at the time. This was primarily due to the exclusive requirement of using ETH to acquire EOS during that time frame. Now, let's turn to regulations. The Commodity Exchange Act of 1936 officially outlawed wash trading in the US. To adhere to these regulations, many regulated stock exchanges employ protective strategies such as self-trade prevention functionality on the ICE exchange, the Intercontinental Exchange. This measure was put in place by the authoritative bodies like the SEC and the IRS. The picture isn't so clean cut everywhere, especially in the emerging markets like cryptocurrency, where the practice still persists. This is why exchanges are investing in specialized market surveillance investigators. Wash trading can be detected by using surveillance tools that monitor market data, like monitoring the value of self trades, the proportion of self trades out of all trades, and the proportion of self trade activity out of all trading activities. The tool will flag traders when certain thresholds are exceeded. Once the surveillance tool has flagged an account for potential wash trading based on the criteria set within the model, a human officer, typically a surveillance investigator, steps in for further analysis. This investigation involves examining accounts' trading activities, looking for specific hallmarks of wash trading, such as simultaneously buying and selling for the same asset, matching orders in quantities and price for the same entity, and typically within a very short time frame. Unnaturally high trading volumes compared to the norm for that particular asset. Minimal impact on the asset price despite high trading volumes. Consistent and repeated patterns of self trading that fall outside of regular trading behaviors. The process may involve looking at the account's trading history and patterns. With that said, we've arrived at the end of this video. Thank you for watching, and I hope you learned valuable information. Please like and subscribe, and I will see you next time.